Good morning, everyone. I welcome you all for this current session of the Think Tank's Knowledge Sharing Series. I would like to call upon Anupam Aditya to get the session started.
Hi, everyone. Good morning, and thanks for joining this session. This is basically one of the web series of the well-known think tank group. We always try to have sessions wherein we can discuss about the current affairs in the financial and the corporate matters, how is the industry growing, and relation to anything we can speak about the profession, what we have. Um, that is what we have. Do we have Yogesh today? Okay, no worries. So Manoj, so we have Manoj Alimchandani. He will give us some overview on the fund management and wealth management. He has good, rich experience in fund management in Indian and offshore funds and financial planning and wealth creation for family offices. So Manoj, are you able to
Yeah, thank you very much, Aditya. It's really a wonderful pleasure to be here with all of you. And this is an excellent series organized by the well-known think tank group on finance, corporate affairs, industry, and capital markets. The knowledge series, I have seen that you have got a wonderful response to it. Now, I would just share a few thoughts on. I would share a few thoughts on wealth management industry. Wealth management is management of wealth for people who have the money and also help in protecting the wealth of the people who have achieved, have some savings and who have invested in certain classes of assets. So in India, the industry of wealth management is at a nascent stage in a formal way. About the last 20-25 years, the SEBI, the regulators have started regulating the industry. Mutual fund industry, earlier UTI was there, well known for UTI 64. Then schemes for other asset classes were started by UTI, equities, debts, liquid funds, money market. Then private sector funds came. Lot of then private sector funds had foreign collaborations with foreign funds. You had lot of foreign funds together investing in Indian funds on joint venture as allowed by SEBI. Incidentally, I was privileged to be part of the process of the private sector mutual fund industry and also offshore funds where foreign investors invested, George Soros, Marlin Partners, Henderson, and other funds. Then there was a request that wealth management should be given to others also, other advisors. So PMS funds were registered, they were regulators. There are lots of wealth managers. What is wealth? We will discuss at length. But some people used to say $1 million of wealth. And what does that wealth includes? It's surplus wealth outside the house you are staying in that you're not supposed to consider whether it is worth 10 lakh rupees or whether it is worth 10 crore rupees. Surplus wealth, which we are supposed to maintain and protect for our future savings, future needs, and for generations to come, or for multiplying and getting a very good risk-adjusted return. This is very important to get a risk-adjusted return. So now wealth management has evolved internationally. Robo funds are there. They are advising on wealth. They are advising on financial planning because a lot of data analytics is being used for investors' requirements, investors' needs, investor profile. Based on that, advice is given to the investor to plan his requirements. That has been very successful in global countries, US and all. India also, we have been discussing in our roundtables and for the last 10 years about robo advisory. I remember we had roundtables on robo advisors a few years ago, 4-5 years ago in a physical setting. Now it is a knowledge series on digital mode. So it has really taken off in significantly in now globally. So this would come. So more data, more profiling, more advice, more quantitative analysis, quantitative models would be used for this process. And also the cost of services is coming down in terms of basis points. Kind of fintech models are being used. So funds management, a formal process, mutual funds, then AIFs came in the last 2 years, then PMS schemes are there, then wealth managers are there. There are a lot of wealth managers. We have a lot of wealth managers in the think tank team. I believe lots of presentations are being planned in the series on wealth management. There are many reputed wealth managers who have consented, and they have in fact approached us. They want to participate and share their knowledge and how wealth can be managed and how risk adjusted good returns can come, and they often feel returns can be much better than what is achieved by the mutual fund industry or AIF industry, where fees are very high, or the hedge fund industry or wealth fees are very high. So there are people who have experience in wealth management, who have experience abroad, who have experience in fund management, who have experience in AIFs. Now they are offering those services where you can interact with them on a regular basis. There are lots of people who says you can interact with me on a quarterly basis. Some say monthly basis. Some say as and when you required. I'm just a call away. It was private banking was there in banks, international banks, private banking. Citibank was one of the pioneers who started private banking, advertising, marketing it. A lot of foreign banks were talking about private banking, banks from Europe. So now private banking has become a familiar word in India also. Lot of banks, they said we have private banking divisions. But then people say there are fees are very high, costs are very high, there is lots of mis-selling. Here the person, the wealth advisor or the wealth management manager or the investment advisor or your friendly consultant or friendly planner. So that's a lot of things. Now, this includes lots of things. It includes technical analysis, it includes financial analysis, it includes risk management, but main is you offer customized what exactly the investor wants, who has surplus funds and he wants to, I would say, not only manage wealth, I would say creation of wealth. Yeah, I hope all of you can hear me. Hello?
Yeah, now we can hear.
Yeah, okay. So the idea is to have a process and then to benefit from fundamental analysis, not only of equities. Equities, you look at various sectors and you look at various companies, their performances, their track record and the future. Also technical analysis and quantitative analysis, applying screening models. Also for any funds diversion they can do or manipulate earnings. So lots of specialized skills are required. And now there are lots of professionals and institutions which are specializing and have developing data, lots of skills with data analytics and investor profiling and investor requirements and being on tap. And the biggest thing is digital. The initiative which Think Tank Group has been talking about for the last quite a few years, and doing it, and now doing in a very big way. So wealth management is being done 24/7. And not only in India, you look at global markets also. Today in Indians, you can invest in Dow, you can invest in Nasdaq, you can invest in Google, you can invest in Facebook, you can invest in a lot of healthcare companies who are providing medical consultation, healthcare services, consultation 24/7. So this has, of course, people say this has increased the stress of the invest not only investors but also people who advise on wealth, because they need to track the volatile markets 24/7. But it's a really exciting field. It's an exciting field of opportunities. So there's a lots we have been doing. My colleagues on the panel, Nipun Mehta, Ajay Parmar, Sandeep Bhatt, and there are many more in the group who have joined. Mayur Parkeria is there. There are lots of people who are involved in wealth creation
You have
and
an
wealth
option called share
advisory
screen.
as a process. And let's discuss all this. I would request
That mute.
maybe the expert panelist, maybe they can share a few words and we can have the presentation, and we are all there. There's an open house. There's a lot of interaction on wealth management on a technical topic, and open house on capital markets. Any issue on any asset class, whether it is bonds, whether it is bank deposits, whether it is money market, whether it is forex investments, or whether it is real estate or equities or any sector, any companies. Let's have a open discussion. And not only in this session, the series which we have planned, I believe it's a very good series where every aspect would be covered. I would say with a deep dive and detailing. So this is a broad overview, and look forward to excellent participation with all of you.
Yeah. Thanks so much, Manoj. This was really interesting. And do we have Yogesh? I can see Yogesh. Can you just provide? Yogesh is a qualified chartered accountant, and he has completed his ICAI, England and Wales, and he has done PhD also. So he will provide some insight on this monetary policy. Hi, Yogesh.
Yeah, am I audible?
Yeah, you're audible. Can you switch on your video also so that we can see you?
Yeah. 1 second. So am I visible now?
Yeah, you are very well visible. Thank you so much.
Good morning all. Am I audible?
Yeah, good morning, Yogesh. You're
Yeah,
audible.
actually, I'm getting these pop-ups for people who are joining. Actually, I just want to stop it. I don't know how I can stop it.
Yogesh, we'll take care of that. You may just leave it over.
Yeah. So, so far policy is concerned, RBI has kept all the rates unchanged because we already had such notion in our minds earlier also that this time policy rates won't be changed much. So the repo rate has remained unchanged. The reverse repo has also remained unchanged at 4 and 3.35% respectively. So apart from that, we have a couple of another updates. If we have to move to inflation, am I audible? I think someone else is.
Yeah, Yogesh, you're audible.
Yeah. So economy is expected to contract around 7.5% for financial year 2021. And it was earlier estimated as 9.5%. So I don't know whether we should say this 2% as a gain or what, because anyways economy has not gained momentum. And whatever inflation we have right now is more of a supply side hurdle. Because of supply side hurdle. That is what I feel. Sorry?
Kindly others mute yourself.
So this is more of a supply side hurdle as what I can see from the numbers. Apart from that, some minor additions to kind of policy resolutions are, this one was regarding banks of not to pay dividends. But I think RBI has already issued one circular regarding this at the time of COVID, that banks are not allowed to pay dividends. So anyways, that circular also stands, and again, the same as a reference in this policy. Then another point which is coming up is banks have told to raise their corporate governance standards. Now, for this particular point, I think there is a background of a recent working group outcome, which we had, I think, 1 week ago, which has been discussed a lot, not only regarding corporate governance standards, but which has some provisions of licenses which RBI will allow for private corporates as well. So that was one point. Second was regarding more kind of regulation of NBFC. So RBI is telling that there will be a scale-based regulations. So even I am waiting for what this will be in detail. Maybe probably RBI will issue another circular or some clarification on this. But yes, this was another point. The next point was that regional rural banks will be allowed to participate in money market. So I have my pointers with me, so I'm just referring to those. So participation in money market was earlier not for RRB. So RBI is telling that this will now be allowed. Apart from that, a different point which I have noticed was regarding stability and governance. So what I can see is that anyways, last week of December, we will have financial stability report from RBI. So even I am keen to know that. Before that, it will be difficult to comment because last week of December, we will get the financial stability report. So let's see what comes up in that. Apart from that, there is no much update as such. If I can see a bond market, if I can just try to pull out that number. So 10-year government bond yesterday, because bond yield slipped, because RBI is allowed to give additional liquidity. RBI say, I think some 10,000 crore rupees will be given to NABARD and NHB. That is what is there. So apart from that, liquidity concern have been kind of answered by RBI. So what I can say, I can see is that somewhere around 5.9% was the rate on Friday for 10-year GSEC bond. So these are the key updates. So let's wait for some more events to be happening in this week, maybe next week as well, and we can catch hold that. One more point I missed actually to quote was regarding a big private sector bank which on which RBI has imposed restriction on digital banking. So that was also an event. I don't think that RBI is light on this, because outage of system is being noticed by regulator and being addressed in very prompt way, itself setting a standard or kind of raising a bars for industry as such. So let's see how it goes in future. Over to you, Aditya. Thank you.
Thanks so much, Yogesh. That was really a great update. And in case anyone has any,
I tried to just encapsulate everything actually.
yeah, that's
So
good.
that
Like sometimes,
speaker should get much time.
Actually, sometimes we just miss on key updates, and that's really helpful to have this summary of all what we had yesterday from Mr. Das. Anything they want to add to this, they are welcome to add, because this is the forum wherein we encourage people to speak and
Yeah, even I am keen to know any views.
Yeah, any knowledge you want to share, because like after that presentation by governor, we actually saw stock market moved up, banking stocks perform well. So anyone who has any view want to share it in this forum, we always welcome that. I'll just pause for a minute. Yeah, Vishesh.
There was one update regarding the extension of the waiver of the loan for another 3 months. So they are thinking of the Kamat committee discussion till the end of March 2020.
So that's just discussion. So like we don't have a confirmed news coming up that will be extended.
Yeah. So it will also affect the market with regard to the banking sector.
So it will affect in a positive manner, I mean.
No, it will be affected in a negative manner, because if the restructuring is again the 3-month waiver further given, so it will have a negative impact on the banking sector.
Yeah, that's really great to hear it from you.
Yeah, good morning. This is Atul Gandhi.
Hi, Atul.
One more update is that now this RTGS will be available 24/7. Then quite soon.
Yeah.
That's another update.
Yeah, that's really good for economic development that we have RTGS for 24/7.
So after IMPS, RBI some time back allowed NEFT 24/7, and now RTGS means transactions above 2 lakh rupees, which will be done 24/7. So we are also waiting for an official notification from what effective date they will start it. But it will be good start actually, because all large payments will start happening even on weekends. So there would not be a reason to stop business on weekends.
Yeah, and that will improve cost to company also, because if my due date is on Sunday, I can go ahead and make the payment on Sunday instead of making it on Friday to avoid penalty.
I just would like to find out from all the people, all the erudite members, what is going to happen with the tax payments. Now, at present, what is the law is that the tax payment, if it is falling due on a weekend or this thing, then certainly we, as per the act, we are supposed to be getting next day payment. Okay. So now with all those avenues available, what will be the legal strength on this?
Yeah, that's something we'll have to wait and watch, because what I understand is like if you are getting benefited somewhere, it should you may have to pay it somewhere else. So
that's fine. I'm just trying to understand the legal view.
participants, can I request Sandeep to start now? And then we have
I'll do
now,
that.
we'll have a lot of discussion in that. So Sandeep,
Yeah, thank you.
let's have your inputs, and then we'll be having an open house. And Sandeep, at about till you can share your thoughts till 11:25, and then we have other panel speakers who can share their views. They are prepared on it. So let's have a interactive session. Yes.
So Atul, in the interest of time, we'll come back to you, and we'll have some people thinking about it and maybe contribute towards the end. We have a panel speaker today on wealth management, Mr. Sandeep Bhatt. He has been CEO for CLSA, and he was a former CEO for UBS, and he's an ex-CFO for ABN AMRO. So I just hand it over to Sandeep so that he can just take it ahead.
Thanks a lot, Aditya. It's a pleasure and an honor to be actually talking to all of you all. Just on the point of what Yogesh said, it is on the dividend which the RBI governor said. He's now put it on even the cooperative banks, is what I understand. So he's extending everything to the scope of the limitation for the payment of dividend even to cooperative banks as well. Am I right?
Yeah, sir.
Right. Okay. Yeah. So
sorry, I just want to add one point here, that dividend part. So this is specifically for this year. So we have that rule that 25% can be, should be returned as should be retained as a statutory reserves. But this year for this COVID only, we have, focused on that 100%. So that's why, for across all the regulated entities, dealing NBFCs or the UCBs also, 100% will be retained. So that's the to increase the capital.
Right.
Okay.
Yeah, that's a very important input actually. Thanks for that. Yeah, and I know going for something like wealth management and financial planning, I don't have to teach you all, because everyone is an expert on that. You're all chartered accountants. But what I plan doing here is, there are times when in this presentation where I have brought in some things which one would not know from the perspective of, what you should be doing in wealth management, or are there any other areas in which you can invest? So I wanted to highlight that in terms of, the perspective. And like, thanks, in fact, Manoj, for giving me this opportunity and the introduction to the wealth management part of it. I'll go ahead. In fact, there are a whole list of things in the contents, but just forget about the aspects there, because time permitting, I'll do what can be achieved today, and the rest of it can be taken up tomorrow. And you will see that fundamental analysis and technical analysis is not there on the screen. So that's a different presentation altogether, which will be in the next sessions. And of course, I need to actually put up the disclaimer as usual. This is not something where I'm coming across as a consultant, nor am I actually making any forward-looking, statements. So this is the disclaimer which I'm giving out. So please, if there is anything which I say on the basis of a forward-looking statement, please have it checked out with your consultant and do as necessary. There are some things, all this, so I don't have to actually repeat it. I'll go fast in terms of some of the things which you all would, of course, know. Bullish and bearish, price and yield. The act here refers to the Act of 1961. So the income tax of 1961. And mutual funds, of course, in the document will refer to as MF. Now, everyone knows what all things you would have for investments. It's real estate, whether it's residential, commercial, it's metals, and metals is the top, top things apart from silver and gold at present. And I'll come to it in my last slides actually. Gold and silver used to be one of the picks to begin with this year in January. And it has turned the, completely changed the, outlook from being absolutely bullish to somewhat a status quo. You may or may not buy it at present, depending on the pandemic actually, and what is coming out from various sections where the vaccines are coming in. So gold and silver might be looked at, but you consider the other things, other metals, for example, iron and steel, and other things like aluminum. All of those have gone up substantially. And I would like to, I'm not going to be coming to this again, and that's one of the reasons why I'm debating here. What is happening is, if you have seen, why is it that metals are going up? China was the first one to have this pandemic across there, and also the first one to actually eradicate or completely, squash all of those pandemic patients. They aren't any patients right now in China. The same is the case with Australia. Now, China depends on a lot of stuff for its metal from Australia. So the mining activity is carried out in Australia, whereas the manufacturing activity is in China. So both of them, if you see, are not impacted currently. And that's one of the reasons why you would see that the shares of the prices of these metals have started going up, and also they might tweak up even further. So that's one thing which is there. Then people don't think about antiques. Antiques is one thing which is an art collector's real investment, because whether it is idols which are 1,000-year-old or things of that sort, or artists drawings, or paintings, those are valued and will go much higher. So these are also considered as investments. So you need to be, those who have the high net worth individuals, which are normally there, would go in for these. Those who have a love for antiques as well as love for paintings will go for it. So that is one thing where people don't normally go for investments, but you can look at antiques as an investment opportunity. Even for that matter, antiques, there are coins, old coins of the Mughal empires, or the range where you have the Marathas coming in with those coins. The Mauryas were the first ones to actually come out with coins. So those coins are actually, in value terms, are much superior right now if they are traded, or those who want to actually sell them off. Then comes the foreign currency, and I'll come to foreign currency later, because what you can and you cannot do will be there. Forex and domestic bonds, and debt and equity you always are aware of. And then the third thing which is there is alternative investment funds. Then you have the mutual funds, insurance products, and commodities as well. So oil is taken as a commodity. For that matter, oil has always been, depressed. It went to around 20 and has come back, and it's now approximately 45 odd. We need to see. I'm not giving any statement right now. We need to see where it moves. If the whole thing on the COVID goes off. Now, I think this is, can you guess what I'm coming to? If someone can actually answer this question, because this is interactive, I want someone to answer what could be this slide be all about. Anyone for that matter?
Cryptocurrency.
Sure.
Good.
Who answered that?
Amit myself, yeah.
Okay, good.
Good.
That's very good. Yeah, this is, and if you look at what is happening in cryptocurrency, it is quite possible that maybe in 3 or 4 years time, you may not have any currencies at all. You might only have cryptocurrencies, where you'll be holding those cryptocurrencies. Hopefully, if all the governments in across the world actually go ahead and say legalize this cryptocurrency basis, this could be the next currency in circulation. Yeah, to come to the investments, everyone knows this, the whole slide, because everyone, are chartered accountants and we know all this. But one forgets that this is not only an investment, alternative, that this is a tax saving scheme as well. So I understand, and I know that the previous budget has given options for actually either going in for this or not availing of these benefits. But these are the benefits which are available, and even if you don't actually go in for the benefits out of the tax saving schemes, these are virtually things which can be invested in. For example, the best thing which one can look at is the pension schemes, and I'll come to that later. And there are some such schemes where, even though it is you sometimes look at it from the tax savings point of view, it is better to invest in that from the broader perspective, from the longer term perspective. Now I'm coming to what is finance and financial planning. Finance is the science or the art of managing money. You have money, you're the king right now, because I think the funds are sitting on cash, and they are actually debating on where to put that money to good use. Because what is right now happening is people are rushing for money, all types of, whether it is by way of debt, you go to banks, you go to funds for, your working capital or whatever is required for carrying on the business. Money is something which is the most important. But the art of actually managing that money is financial planning. What I told you is something to do with business. The same is the case with your household. So financial planning, in short, it is conversion of your wealth, of your personal wealth or assets, or which is liquid, measurable at any given point of time, into a valuable asset for the future. Financial planning is a decision for and the first thing which you do when you actually go for financial planning is setting up goals. Without goals, you are not going anywhere. So the first thing which you want to achieve is a goal where you say that I want to retire at, say, 50 or maybe 45. And do you want to actually start your own business or something like that? Or you want to peacefully retire at 55 and do nothing but the generation of income from whatever you have saved and your corpus which you have generated during retirement will take care for generations to come, in that sense, till you're alive at least. And not only that, it passes on to your legal heirs also. So you need to actually plan in advance to achieve that goal. And how do you do it? I'll go very fast here. Salaries, less expenses, and savings. You all know how all about these things. The interest rates are very, very low at this point of time. One of the reasons why the stock markets are really pumping and going up, that is one of the reasons. The other reason being there's enough liquidity in the markets for the stock markets to go up. So those are two things which are, completely different. Your personal aim and the goal which you are setting is the key to, again, I say, this is very important to form a corpus for a later date. And I call it the pearl. Planning for a purpose. You go early for the investments, you start early, you make it regularly, and you do it for a longer term. And that will be beneficial. You plan for taxes, you plan for your insurance, you do your retirement planning, you do your estate planning as well. And then altogether, it's financial planning and wealth management. The general rule for wealth management and financial planning is the age-old rule, where you call it 100 minus your age. So suppose when you consider your age as, say, 45, you deduct that, or rather, I'll take the example which is given in the slide itself. Deepak's age is 35, Aarti's age is 25. What should be the factor where you put money into the equities, put money into your debt schemes? The thumb rule is that you put 100 minus your age into equity and 100 minus, or rather the balance, in debt. So as you grow older, you have debt exposure which is much higher and the safety measure which is much, much higher. So when you are young, you can actually start investing in equity. When you grow older, you start investing in debt. Then the drawback of the rule is what happens, you can't really be sitting on one investment, because like Manoj said, you need to review it on a half-yearly basis or a yearly basis. So what happens here is, if the markets are really, likely to turn, you might want to come out of equity, invest in debt, or vice versa. And therefore, there are different models for assets which have been made out by the mutual funds, where you can do it yourself by direct trading. What is called the strategic asset allocation, where a portfolio is built purely based on the needs and preferences of an individual. Say, for example, 60% for debt and 40% for equity. So it is your choice. You might not have planned at all till you're, say, 46, 47. All of a sudden you think that you should be planning. You might go in for this, strategic asset allocation. Tactical asset allocation is timing the market. So like I said, it is quite possible that the equity markets might come down. So you come out of the equity markets, go into the debt market, invest a little more in the debt market till such time equities are likely to come back as an investment opportunity. And the dynamic asset allocation is one where you actually interchange. So you have a period for, say, 3 months or 6 months or a yearly basis. You decide upon that allocation. The allocation should be 50-50. The time when you actually do the you actually have a look at the review of your portfolios, you might come across a scenario when you're reviewing it where your equities have gone up from 50 to 60. You could actually sell off those 5%, So, and invest in debt, to again come to a situation where your allocation remains 50-50. So that's called dynamic allocation. But I would always look at it from the tactical asset allocation point of view, when you time the market to such an extent where you don't actually lose out the opportunity of selling when you need to and buying when you need to. I said in the Pearl example, the point on, starting early. And here is an example which I have given: a smart investor versus an investor who is a freak investor. A smart investor is the one who actually invests early. So in one scenario, with the age 25, the smart investor starts investing, even consider it as a fixed deposit. I've considered a 10% fixed deposit, which you'll never get under the current scenario. But still, I'm saying, if you actually start investing and make an average return of 10% per annum in your portfolio by saving that amount, whether in equities, debt, or any other instrument, the chances are that at the end of the period, for example, at 60, you start investing 20,000, you end up with 59,82,536. And if you start at, say, age 41, you end up with, say, 32 lakh only. So there's a difference between, starting early and starting late. So start early is something which is always advised. People tend to actually spend more when you are young. You go for those fancy mobiles. You go for fancy equipment. That is something I don't have to tell chartered accountants about it, but that's the general nature. And you might want to actually tell your kids as well, those who are growing. This is something which is to be kept in mind.
So, Sandeep, in the previous slide, you have taken an example of 20,000 per year.
That's right.
So, an investor who does a 20,000 rupees investment every year for, say, 35 years can, so like, it can be a mix of.
It is compounded. It is compounded.
Yeah, it can be a mix of equity or can be a debt. And if we anticipate a return of 10%, it can go to 59 lakhs.
That's right. That's right. That's what I'm trying to, put it out for you. So the younger you are, you start investing early, and you reach a stage where you don't regret. So at a later date, you will end up with a corpus which is much higher.
So like with the gradual increase in your investment amount, this number can go exponentially.
Absolutely.
Very high.
Absolutely.
Yeah.
This is a slide where I'm talking about ownership and liquidity.
Sandeep, we are not able to see the slides. So it's only we are on the first slide still.
Sorry,
I'm able to, like, Anupam, maybe you may have to
okay, fine.
Refresh it.
Right.
Yeah.
Okay, we can see it. Yeah.
Okay, thank you.
Okay. I'm sorry. So one thing which you should keep in mind, and actually one never comes across such a slide. Either it is a slide for the business or for yourself. It's never for your country or the community, for example. What is it that is possible for example, the municipal corporation or the country as a whole for investment purposes? And if I can answer it in one word for that matter, for the country, you have deficit financing. That is one, which is a bad thing, of course. but for giving impetus to growth, you need to have it. But what is it that a country can have and hold? Real estate, a country can hold. Infrastructure projects, the country can hold. Precious metals, gold and silver. In fact, gold and silver saved us in 1991. We were short of the reserves were $3.5 billion in 1991. We sold gold, or rather mortgaged gold, to a bank in Switzerland. We actually managed to get some foreign currency. From there, we have started and we have reached the point where we are right now sitting on $536 billion. Now, what does that mean? India has a lot of gold reserves. So it is good that we had gold at that point of time. You also can invest in gold, and towards the end of my presentation, I'll come to it, as I'm having different classes of these investment items. You have foreign currency. Even foreign currency is very, very important for a country, and I'll come to it because I remember distinctly when I was in. Actually, I'll share this as an example. I'm going very slow because we have time, because we can spread this out in 4 lectures. I'm giving you examples as well because you will come to know. When I was in JM, Mr. Kampani used to actually interact with me at that point of time. I was young, but he used to interact with me, and that's a blessing and that's an honor for me. And we were discussing in one of the parties, and since I used to do technical analysis at that point of time, I mentioned that the dollar is going to fall, whereas the other currencies are going to strengthen. And what are the other currencies? Other currencies are the Swiss franc or the Japanese yen or something else. They are likely to actually go up. Now, what happens when a country is having such a holding of foreign currency? They could do a swap, and they really did it, actually. Manmohan Singh was the Prime Minister at that particular point of time. Mr. Kampani came and told me afterwards, they made a swap. India gained $1 billion out of the swap for a short period of time, till such time when the dollar started going back up again. So you can do it if we are allowed, actually. If we are right now not allowed to do it, if we are allowed to actually swap currencies or hold currencies and swap it, we might be able to trade currencies as well. So right now it can be done by the country. It can be done by the banks. But going forward, if we become convertible, it is quite possible that you might be able to do it yourself. So that's one thing which I'm trying to put it in your mind, that this is something, an opportunity which can be utilized as well. Then you have natural resources, fixed income, venture capital funds, stock, shares, derivatives, insurance products, cash and cash equivalents. And here's where the problem comes in. What is the item which is liquid or illiquid, risky, not risky, where you can actually invest, go and invest? When you are actually going towards your retirement stage, you would definitely not want to take risks. So you would invest in government bonds. You would definitely have a lot of insurance products, bank and term deposits, real estate, definitely. So all these would be there towards the end of your retirement. But what would be there when you are younger would be precious metals, antiques and art, currencies, and equities. So this is something which you need to keep in mind. So where I'm coming from is you can start investing in equities. You may invest in currencies if and when you are allowed. You may pick up antiques, precious metals like gold. You now have the opportunity of actually, I'll come to that later. You can actually have ETFs, gold ETFs, and gold mutual funds also. So there are opportunities which can come in, where you can invest when you are younger. Towards the when you grow older and towards retirement, you will have the bottom half left hand corner of your screen, which will be what you would want to do. Then the point on what is actually, whether it is high growth, what are the areas of high growth? Equities is high growth, so you would actually go in for equities at a younger age. It is risky also, but you'll take a suitable allocation towards it. Then you have regular income, whether you want to have regular income or not. That is the objective which one will have to decide upon. When you are young, you could go for equity. When you are a little older, regular income, you might need liquidity by keeping deposits in banks and capital preservations. So in short, the right hand side actually gives you the suitable investments that is to be made. In the box below, you have what is relevant for you to actually see. One is the risk factors, as I've already said. The other and most important factor is inflation. And this is where we are being hit right at present. Right now, the inflation is somewhere around 6%, whereas your fixed income, rather the fixed deposits, you're not getting more than 4.5%, 5% on the short-term tenure. So it doesn't really give you a return. It is a negative return. So all the money is right now going into the equity markets, but mind you, it is risky. So, and the last thing which is there was, and the first initial thing which I had told you is savings for tax saving schemes. Whether it is tax efficient to save. For example, I'll give you this example. Is it when you're investing for a flat, in a flat, you get this advantage of for tax. Now, whether it is by way of interest or by way of a principal. Now, you will have to decide whether it is tax efficient to actually invest in a flat or a second flat. So you'll need to decide whether what happens in the case of your tax effective rate, which comes in, whether you save taxes or it doesn't make sense. So the decision will lie upon that. This is the process which I've already, commented upon. Some of these things which you would already know. Assets, you will have mobiles, music systems, cars, etc. Household essentials. You have investments and saving schemes. And what would be your expenditure? You might have your own marriage or marriage of your siblings, for example. Your excursion, that is important, not under the current scenario, but holiday definitely is in your mind right now. I can see each one of you jumping up and down to go out from your residence and go out and do an excursion. You then have post-retirement annual expenses and emergencies. So you need to actually form a corpus, the total investment corpus, based on which all these can be taken, the bottom line can be taken as your future necessity. You can, at that point of time, live a comfortable life. This is where I'm trying to tell you whether you should or you should not invest. I already took that example on, the real interest rate based on the inflation and the tax. So it depends on whether or not, whenever you are investing in any, whether it is a bond or in equity or a fixed deposit or any instrument, you need to take the real rate of interest into consideration to check whether you are really making money or you are actually losing money by way of, because inflation might be much higher than that. So you need to take that into consideration as well. I'll come to the constituents of wealth. What time should I be stopping?
Sandeep ji, there were a couple of member participants who have joined us on YouTube. Okay, so they have posting their questions there also. So if we can, one question here they have raised is you are requested to give current tactical allocation considering the current market valuations. They also want to know if there are any major variation corrections expected, and what should retail investors do, whether they should invest fresh or shift to debt.
Okay. This is like a forward looking statement again, where one is asking me to actually tell you all about where the markets will head. That just one second.
Well, that's a very interesting, exciting question. I think we'll take it up in the open house.
Okay, sure.
Great.
Okay,
we'll take lots of questions in the open house, which will start from 12:25, and everybody, all the panel speakers will be there.
Okay, sure. That's a good one.
And Sandeep, you have some 15-20 minutes to wrap it up, so like you can go at your ease.
I might not be able to wrap up everything because I will go to a stage where I will say if it is 12:20, it'll cut off.
It's a series.
So
it's a series. We'll continue the sessions so that everybody gets value, and of course all the panelists, including you, will be there till the end to interact with the last participant.
Absolutely, absolutely. So I'll take one by one. Like I came across in the first slide itself. Real estate.
Hello.
Yeah.
Hey, Ajay.
Hi, this is Ajay Parmar. Sandeep, I just want to, your presentation is really interesting. I just want you to keep your normal pace. Don't worry about the timing. I think we can take it in the next session also. But,
no.
I think I'm getting a good, everybody's learning out of it. Yeah.
No, that's one of the reasons why I'm going very, very slow. I'm not concerned about timing.
Yeah.
I'm not concerned about timing at all.
Right. Okay. Thanks.
The best thing and the first slide came up was real estate. In fact, I've given some steps where and how to assess how you should be buying a house. It's there on the slide, but I think a ready position flat is always a better way of looking at it, even under the current scenario, whether it is under the current scenario or even in the past. I would always go for a ready position flat or a flat which was almost ready. It would take about 2 months for it to be completed. Not a flat which could, the foundation is being laid. Even the best, you can imagine the best of builders have also suffered. So it is actually incumbent on, when we think about this, be very cautious in buying a flat as well.
So Sandeep, when we say that, suppose a project which is like partially initiated, so like you have like a big project wherein 1 or 2 building is already constructed, and you see, like for example, like we have Sapuji Palanji coming up in Thakur village, wherein they have built 2 buildings and they are constructing on the other areas. That also you think that can be a risky thing wherein they give a position in 2025?
That's why I put the point B there. Point B, where you have people like, for example, Oberoi or L&T or Shapurji Palanji, or for example, Lokhandwala, used to be good. Now they are nowhere in the picture after the demise of the original owner. So there are some builders who are very good. Godrej, for that matter. These are very, very good names. Rahejas. But you never know when they will come across difficult times. Let me put it, and you rightly asked the question on Shapurji Palanji. Why are they liquidating their assets? They are liquidating some of the other assets to see that they have a name to
Yes.
You actually don't want to spoil your name, right? They will sell off the other assets to complete your projects, but they can land up in trouble. And when there is no demand for your houses at all, you build houses and there is no demand, it'll be a problem. So there won't be rotation of the money at all for them to go to the next project. For example, he might have wanted to build a third building. Now, that is where even RERA comes into the picture. Okay, so from that perspective, you have to be very careful which projects have RERA or not. Are they registered properly? Complete one project, go to the next. Complete one project, go to the next. You need to be very careful about that. So don't go into something which some builder where you don't know them at all. And I'll be very, very careful. I have actually myself changed 5 times. For me, I want to actually give my experiences as well. I have taken real estate as like a commodity, like any other investment. I have not stuck to one house. I have changed 5 houses. And the reason being, if you think that you are going to make money, you can sell off the house, take a house somewhere else, you make money there. That's the objective. Or if you want to invest at a time when the prices are at the lowest. And if I remember right, 1997 was the time I bought a place, and 2001 was between 1997 and 2001. The prices were at its lowest. Unfortunately for us in India, none of the what they call the online brokerages, 99 acres and all those guys, they give you rates of a particular place or a particular area. But if you go and look at the sites abroad, for example, you have Australia, for example, they give you a chart. On the basis of the chart, you can actually at least, if not with oscillators and things like that, you can actually see how prices have retraced from a particular level or how much they have gone up and are retracing. So when I bought the flat in Lokhandwala, for example, in Kandivali, I was in Kandivali earlier. I bought it on that basis because the prices had fallen from 1995 at the peak. Prices had fallen 61.8%. Okay, and when you must have heard all of this, 61.8, 50%, 31.2, 38.2%, all in the scheme of the stock exchange. Real estate is also an investment. So if you don't have sentimental values to real estate, like I don't have it at all, you can actually change houses and make some money on that as well.
Yeah, that sounds really interesting, because like sometimes you just consider your house as just one of the object.
That is because you are very, you have sentimental value, because you say that, oh, this is my first house, right? I don't want to sell it at all. I want to live in this area only. That's not what you should be doing if you are able to make money.
Same thing applies with stock market.
Absolutely. Okay, yeah, now
thanks.
I told you about the real estate. The same thing, if you don't want to actually get into real estate, what you can do is buy shares of the real estate companies. In B, I've already mentioned that. Like, for example, L&T, Oberoi, DLF, you can buy shares of that. And the third investment opportunity, one doesn't look at that, is REIT. And I remember Manoj, when we did our first, a round of meetings at the BKC in the institute's office. He had come out with the REITs, the IPO papers. They were going to file the, DRHP. And this is one area which can actually grow, where, it depends on really whether or not, some people say that commercial property is a thing of the past. People will start working from homes. Commercial, real estate won't go up at all. That might be a misnomer for all that matters, because there are some industries where you can't work from home. You need to go to the office. Marketing, you can't sit in the house and do marketing. You need to have a strategy to be built. You need to have advertising. You need to actually make a group and brainstorm. So commercial estate definitely will be required. And that is where REIT companies will come into the picture. They buy off real estate, commercial projects, and rent it out. This will be a type of a pension scheme, for example. The profitability might not be great or that high, but it'll give you a return. And then you have in B, your real estate investments in land. Land will never depreciate. I'll tell you that. Land, it is very difficult for land to depreciate. It's a simple thing where demand will go lower and desperate sellers will sell it, but value of land will not go down. Same as, you have farmhouses, urban land, house properties, and commercial property. So,
Sandeep, I remember I heard somewhere that we don't have a planet 2.
I'm sorry?
I'm saying I recently heard one statement that we don't have a planet 2. It's just one planet Earth we have, and the lands and other resources are limited.
And people have started, maybe aliens have come in and, started putting things in California and some other places as well. You have seen the pictures of the aluminum bars. We don't know who's put it. Yeah, it is so, because land is scarce. Population will keep on increasing unless there is a pandemic which comes in, the type which is right now in existence. If the US doesn't do their homework, it's going to be chaos in the US, because right now they have crossed the I think it was 217,000 per day mark yesterday, with 2,900 deaths per day. God forbid, if something happens here, we don't want it to hit India again. It'll be very, very bad. And I was to start this session by telling each one of you to be very, very careful when you go out. And you know, I had to go out literally for some meetings and other things. I got some symptoms like a headache and cold and other things. I got tested. It was negative just 3 days back. And I told Manoj, boss, I'm getting tested. So I don't know if this session will go ahead or not. Luckily, everything is fine. But each one of you, I would, you know, tell you to be very, very careful, because this Trump is, I will say this very clearly, Trump is a mad guy. If he thinks that, you know, without masks and without uh, taking precautions, these things will go, he is wrong. So we need to be careful in India to see that these things don't, you know, blow up again. So here is a case where I've listed out what you should be doing. You go to a reputed builder is what I've said. I told you so. I'll go to the next slide. Okay, I'll read through this. I'll go a little slowly on this also. Whether you want an independent house or an apartment, that is one thing. Whether you need a clubhouse or things of that sort, or what you're looking at is fiber connectivity and other things. You know, a very old building might not have fiber connectivity and things which is possible. I'm not too sure of it if they would be able to put it in there, because old houses never had ducts. You know, the new buildings have ducts where the cables can run through. Old buildings don't have that. So I'm not too sure of how old buildings can have the fiber connectivity and things of that sort. You maintain your budget per month where your EMIs are worked out. That is something where you will have to work out for investing in real estate. How will you fund the house, fund for the house? Whether it is your own funds, whether you want to take a loan from your PF, all that will need to be checked. And where you end up at the end of it, that is end of the corpus in the year of retirement, is something which you need to look at. Is a house important or is money important? Both are things which are very, very important. So it is quite possible that you might want to look at a 4-bedroom or a lavish flat or a 5-bedroom flat. But if you can do with a 2-bedroom flat and have some money at retirement, the alternatives are for you to decide. So from that point of view, I'm cautioning the youngsters to actually go for, you know, decisions, not lavish life, depending on how you are, what you should be doing, you take your decisions. Primarily with the keeping in mind one very important fact. If you did not have money at the start of this pandemic, I don't know what could have happened. You know, if you did not have investments, you can either get, you know, if you're unemployed after that, if you don't have your money, all these emergencies do arise. And all these things need to be considered while actually investing for a corpus for a later date.
So, Purushottam, you raised your hand. You were asking something? Okay. Sorry, Sandeep. Go ahead.
I think what I should be doing is, whoever is there, I can very well share this presentation with you all, because I don't want to be, this presentation, I don't want to be proprietary. I don't want to keep it near my heart, you know, because this is a learning. I have tried to I have tried to actually put in things here where people can learn from it and digest it. For example, this point on builders. Check the list of documents which you are going in for. Copy of the agreement for sale, registration certificate, GST receipts, all the other things, blah, blah, blah. Okay. So here is a case where I've told you what should be done while buying a flat. And what I've done here is in each of the elements where I've said wealth, real estate, I've given how these are valued. Okay, from the perspective of valuation, the market value of the real estate is based upon the demand and supply. All of course know about it. And these bids and offers can be known from the, the online. Hello. Yeah. All these bids and offers can be known from the portals, like online portals like 99 Acres and Magic Bricks. Second method to actually value it, you go and check out the ready reckoner which is there from the stamp duty point of view. That will give you an approximate value around around that area. So that in short could be a valuation which can be done. From the value that is it too high? Are you going to pay much higher than the price which is really there? So this is one of the ways of doing it.
Yes,
I would say that you look at the portal, but you don't rely upon the portal because the offers are much higher.
Yeah. Yes, Sandeep,
okay,
that's really good to confirm that. Yeah, you are happy to share this presentation with all of us, and yeah. I will ask Manoj to have some inputs on this in case he wants to speak on it, and we can have continue, Sandeep, on the discussion.
Just 1 second. I think I'll just the remaining 2 points which are there.
Yeah, that's perfectly fine. Yeah.
One is the income tax. The valuation I have completed. Income tax, you all know, again, chartered accountants, section 22 to 27. And then for capital gains, you have section 54, 54EC and 54F for working out the capital gains. And the criteria of your second house. Whether capital gains, or you can actually buy off or sell 2 houses and invest in a house. That also is given in the last important note. Yeah, you take over, Manoj. All the other